Hi, today we are going to talk about equity valuation. As discussed previously, equities are different from bonds in the sense that equities are assumed to exist perpetually, as opposed to bonds which will cease after a certain number of years, as being stated in the contract. It's not that the equity holders is expected to live forever, but rather the equity itself is expected to be available, to be traded, to be held forever by different shareholders. So also equity holders have the rights to vote in towards as to the direction of the firm, and is able to participate in the profits and loss of the firm, and bondholders are not allowed to do so. Okay. Also, just before we begin, we need to distinguish between the intrinsic value, or rather the fair value, from the market value. It's not to say that after going through this subject, we are able to price and then trade stocks and profit from stocks in a very short time frame. That's because market value relies a lot on sentiment, and in the short term, market value seldom tends towards the intrinsic value. Okay, there are basically three approaches that I'll be going through today. The first one will be the present value approach. The second will be the price multiple approach, and the third one the asset value approach. Let me start from the present value approach. The formula for a present value approach is straightforward. It's basically to arrive at the present value of future dividends. So we can see from this formula, the denominator are all the discount rate, and the numerator is the dividend, the future dividend. So yeah, it should be straightforward because we went through the present value, future value concepts a while earlier. Okay, so imagine there are some companies which have not yet been able to give out dividends, or rather, or some companies are withholding dividends because they think that they have better use of dividends. So what do? It doesn't mean that such companies are zero value if we plug into this formula. So for such companies, we should use, instead of dividend in the numerator, we can use distributable cash flows. So we can look at the annual reports for the cash flow statements, and arrive at the amount they would have distributed had they not retained all the cash flow. So this is another technique that we can use, but we can using the same formula. So yet other companies have different stages of growth, and when they grow in different spurts, the dividend that they issue will not be the same. So to do that, we can also use the same formula, but instead of using one single formula to discount all the cash flows, we can split up the whole entire period into several phases, and each phase will have their own dividend model. Okay, and one particular case of such dividend growth is shown here, which is commonly known as the Gordon dividend growth model, where the dividend is expected to grow at a constant rate G, and the denominator will be the same. It's 1 plus required rate of return, and basically the idea is the same, and we are supposed to discount all the dividends back to the present value and then sum them up. Okay, and this whole equation reduces to dividend in the first period over required rate of return minus dividend growth. Okay, I think I will stop here and show you the derivation of this formula. let me write down the formula first. So the value of the firm is given by the summation of the dividend, which grow at the rate G, divided by the required rate of return, which is also known as the discount rate. Okay, time period starting from 1, and this grows to infinity. Okay, so we can rewrite this expression by first bringing out the D0, because it has no T term, it has nothing to do with the summation, and then write these individual values by removing the summation sign. 1 plus G to the power of 1, okay, over 1 plus R to the power of 1 plus 1 plus G over 1 plus R to the power of 2, and so on, all the way to the infinity term. Alright, from here we can see that if we take out 1 plus G over 1 plus R, this term is reduced to let me call this term x squared plus x cubed okay, all the way to infinity. So this x is basically 1 plus G over 1 plus R. Alright, so we can see from this expression that this is a sum to infinity of a geometric progression where the factor is given by 1 plus G over 1 plus R. Okay, so this whole term can be reduced to 1 over 1 minus x, which is equal to 1 over 1 minus 1 plus G over 1 plus R. Alright? So if we look at this whole expression, we can simplify it by doing this. D naught 1 plus G over 1 plus R. I'm writing this term here, and this term can be reduced into 1 plus R over R minus G. Okay, this term cancels out, and then we have we can see that this term basically refers to the year 1 dividend. Okay, so we can write it as D1 divided by R minus G. Alright, which is what we try to set up to prove. Let's return to the PowerPoint slides. Okay, so the next technique that I'm going to show you is to use the price multiples of comparable companies. So assuming that we want to value a telecom company, we can find a similar telecom company that operates in the country, which have similar revenue model, is in having the same currency revenue, and having the same size and so on. So we're trying to find the similar type of comparable company, and assume and make one important assumption that the price multiples of such companies are the same. So let's say the price to earnings ratio of this company is the same as the price to earnings ratio of the company that we are trying to value. So we equate the two ratios together, and then in order to arrive at the valuation for the company that we're interested in. Okay, so this is straightforward. And finally, the last technique which I'll be talking about is to use the market values of the assets less the market value of liabilities. So you can think of this as assuming that we want to dispose and sell off this entire company. What is the value that we can get? Okay, so what is the value that we can get is simply selling the assets, taking the cash to pay off all the loans and all the liabilities, and the remaining cash will be the final value of the company. And on a per share basis, simply divide this final value by the number of shares issued. Alright, so this is straightforward. So you may ask, why are there so many different techniques and which is the correct technique to use? Well, there's really no correct technique to use. Different analysts will use different technique, and in fact most analysts use all the techniques and then compare against each other. So you can see that sometimes we can have different analysts making different calls on the same company. That's because the assumption that different analysts make are different. Alright, so I mean, just take as an example, when a company has just been incorporated and the shares are not listed, it certainly has no dividend to give out. So how do we value? We couldn't value it using dividend model. So some of the techniques that we should use to value such companies are using the market value of assets less liability, or the comparable ratios. Okay, so that's all for today. Thank you.